Looking at the Markets with David Modell. Welcome to Looking at the Markets with David Modell. We're back with Mr. Seth Golden, a frequent guest here at Looking at the Markets, and one of the guys out there who is an expert in the markets. And if you have questions about the retail sector, about the VIX, about volatility, or about trading or investing in general, Mr. Seth Golden is the man to talk to. Welcome once again to Looking at the Markets, Mr. Golden.
Thank you, David. Those are kind words, probably too generous, but much appreciated nonetheless.
Absolutely. And I think they're well deserved. So tell us a little bit first about Golden Capital Portfolio and your investment strategy.
Sure. Well, I began Golden Capital Management in 2012 as a subsidiary to Capital Ladder Advisory Group, which was a firm that I was partnered in. At first, it only included the Capital Ladder affiliates and partners' capital in the fund, but as the returns generated year over year proved to beat the benchmark S&P 500 returns on capital, I gained a sponsorship of Wells Fargo, and since 2012 I've grown the fund and the capital invested. In 2012 I was managing roughly $3 million in investing capital to where it sits today, about 5 years later, at $71 million in the fund. So I've also grown the client base from 6 investors to 38 investors since 2012. It's a small fund, but the returns on capital invested have been upwards of triple digits in each of the last 3 years. To give you a kind of a perspective on what I invest in and how I manage the portfolio, the greatest portion of the funds is dedicated to VIX leveraged instruments. Since 2012, I've maintained a short position in certain VIX leveraged instruments, such as ticker symbols UVXY, VXX, and TVIX. The portfolio generally has about 20% of capital invested in VIX leveraged ETFs, and that decreases and increases from time to time depending on the opportunity I seek to capitalize upon in the market. In fact, that percentage allocated to VIX leveraged instruments has decreased most recently.
Yeah, and your returns on capital in the Golden Capital Portfolio on UVXY, which is a VIX leveraged instrument, something you have a lot of expertise and experience with, but your returns have been very, very strong. Can you tell us about that?
Yes. Well, the VIX leveraged instruments, especially the ones that are designed with decay in them, like UVXY, VXX, and TVIX, I started investing in them in 2012. And these instruments are leveraged to volatility. The nature of volatility in and of itself is that it remains complacent for much longer periods of time than it actually expresses outsized fear. So these instruments are tied to volatility or correlated to volatility, but they also have an intrinsic decay in them, which causes them to decline over time. And when you get those long periods of market complacency, we'll call it, these instruments just fall and fall and fall in price.
Yeah.
So dedicating a large percentage of the Golden Capital portfolio to these instruments from the short side works very well in this type of market where you have it's a very complacent market. It doesn't express a lot of fear, and it has obviously low levels of volatility. So that's how I've been able to generate very large returns over the last several years.
Makes sense. So let's talk about the markets overall. We're just off of all-time highs once again. Yeah, I read your latest article, and we're going to put a link to that. You discussed all this, but would you be able to expand on your thoughts here?
Sure. Well, to kind of streamline it, I would say coming into this week especially. So, last week we had what we'll call it a no vote on the healthcare legislation. So there are two ways to kind of view that in the market as an investor or as a trader. And the two ways that I was looking at it is, okay, we had a no vote on healthcare legislation. So there's one camp that might suggest, well, if there's a no vote there and the administration couldn't pass anything on healthcare, maybe they're going to have difficulty passing legislation with regards to tax reform. We've come a long way in the market over the last several months because we anticipated some type of tax reform. So the market has gone up ahead of that anticipation. In other words, it's kind of priced in that tax reform was coming. So, if we can't get, legislation passed for one aspect, maybe we're not going to get it passed for tax reform. So you have that as kind of the bear camp or the skeptics camp. And then, but on the other hand, or, the other side of the coin, you have the optimists. And they may look at it as, well, we didn't get any passage on healthcare legislation, but what did that really do to the economy? Does that really change anything for the economy or the markets? As of right now, no. Nothing's actually changed. There's still the possibility for tax reform, and there's still the possibility for healthcare legislation, later on in the year. So nothing's really changed here. So that's the optimistic way of looking at it. So you have kind of a tug, push-pull scenario going on, and it's kind of showing itself in the market with the market going sideways. So overall, what I would say is the trend is your friend, and the market overall has been trending up. And until we have a true catalyst, and that's the other thing, we don't really have a true catalyst to incite a market sell-off. And generally, history has shown us that you need a true catalyst to incite a sell-off in the market. And there's not really a viable one there that breeds any fear into investors. So I believe the trend is your friend, and the market will either tread water or continue a gradual uptrend.
Gotcha. I love to talk about retail. Full disclosure, I have a position in Target right now. So I love talking to you about Target. First, well, actually, let's go general then specific. Generally speaking, retailers. Which retailers are giving you a cause for concern right now as an investor?
Yeah, that's a very good question. So the ones that give me cause for concern, if we're talking about, in general, I like to talk about big box retailers, mainstream department stores, those kinds. So from that perspective, I would definitely say Sears Holdings. They all but said that, come the fourth quarter, we may have some more announcements surrounding our going concern as a retail outlet. So that would be at the top of my list. I think the next in line, I would have to say, from a debt and profitability standpoint, would be JCPenney. And don't get me wrong, when I say JCPenney is a concern for me, it's not as a reflection of where they've come from 2012, because they've done a lot of heavy lifting, did a lot of really good things over the years. However, they've only gotten to this stage where they are, eking out some profitability, but at the same time starting to show real signs of cracks in their sales. And they're projecting basically negative 1% to positive 1% sales growth this year after coming off a flat year for sales last year. So that's a concern for me. And then from that point, I would probably say Macy's and Kohl's are retailers that at the very least, I would avoid. They're not really showing signs of turning around their metric performance. You have Macy's increasing the number of stores they're closing. You have Kohl's, even with a huge buyback plan that they initiated towards the tail end of last year. You have EPS declining and sales declining. Same goes for Macy's, EPS declining, sales declining, new CEO at Macy's. But the core structure of the Macy's business, there's really no viable change there. It's more or less steady as she goes. All of these retailers offering tons of initiatives. We're doing this. We're doing that. We're adding this brand. We're adding this service. Unfortunately, none of that is incremental. They're just pieces of a puzzle that still can't bring the whole thing together to produce growing sales and growing EPS. So despite all these initiatives, there's something structurally wrong with these business models or retail concepts, if you will. So those are my list of, at the very least, avoids. With regards to Target, I also took a position in Target, about a month ago. Found myself underwater. Fortunately, had the opportunity to make a couple trades in the name, and am basically back to even. Not counting the dividend. It has a really strong dividend there. Right. What I do like, so if we compare Target to the other named retailers, they're not quite net closing stores. Having said that, the amount of stores that they open is greatly curtailed, and the types of stores they're opening are a bit of a change in concept, opening smaller stores and smaller format stores in urban areas. I don't necessarily like that idea. I don't think it will work for Target long term, but it's something that's that they're trying. What I do like about Target is it does have a unique position in the retail landscape as a hypermarket, meaning they sell grocery and hard goods. Their grocery section is one of their biggest hurdles to overcome, and unfortunately, they're heading into a cyclical problem where they're meeting the demand online for grocery. Grocery online is growing exponentially, and Amazon has a big initiative that they just kicked off, inviting all of the CPG, consumer packaged good companies, to their headquarters to basically make their case, make the Amazon case as to why you should sell direct to the consumer using the Amazon.com platform. They have Mondelez coming to this invite-only initiative or speech, if you will. Of course, Kraft Heinz and all the big CPG players are coming there. So Target has its work cut out for it, but it has a very nice dividend. It has some insulation based on the segment of the market it's attacking. So I like that one above the others, which are more or less just department stores. They're not hypermarkets.
Very good. Well, that makes me feel better about my position as well, and I do enjoy the dividends. Absolutely, it's one of the better dividend companies. Now, for those who don't know, Mr. Golden is a frequent contributor to TalkMarkets.com as well as SeekingAlpha.com as an article contributor. You've written probably a couple dozen articles on Target. I'm going to put some links up. For example, you wrote about Target and the big retail bust. You wrote about Target store operations. But you've also been critical of the CEO, Brian Cornell. Should he not be leading Target right now?
Okay, so frankly speaking, Brian was never the right person, in my opinion. Just my opinion. I actually wrote an article explaining why Brian Cornell was not the right guy for Target when he was named back in 2014. I did a careful, analysis on his history, his work experience, his background in both retail and CPG. The alarming thing that I found is when you look at Brian's history, whether it was at Michael's or Sam's Club or Pepsi, he really didn't stick around for very long. I don't think there was a single tenure of more than 3 years. So here we are at his 3-year point, and we haven't really seen any benefits from his leadership. You would think at the very least, with his consumer packaged good background, he would have done a better job with the grocery category at Target. But all we've really seen is steady declines in grocery from Target and various different initiatives to, change the product, change the packaging, change the format of the grocery section at Target. But it's been for naught. I would say, Brian has, I'm sure he has all the best intentions and is putting forth his best efforts, but this is a really tough environment, and I'd be hard pressed to say who would be the right guy for Target. All I know is the efforts that he's put forth so far finds Target back where they were heading into 2014 so far as EPS, earnings per share. They're expecting earnings per share just under what they had forecasted for the 2014 year. And I'm sorry, but that's a real red flag there for me. If I'm characterizing the efforts of a CEO.
Makes sense. Just a question that's been on my mind, as we are both frequent participants on StockTwits as well as Twitter, and of course I'll put up links to your StockTwits and Twitter profiles, which everybody should check out. If you're not following Mr. Seth Golden, I don't know why, because you really should be. I noticed real quick that on Sears, everybody was bearish. Now suddenly everybody's bullish because it has gone up so much in the last week. What would your advise now, with the disclaimer that we're not advising any purchase or sale of any particular equity? What would you say to somebody who has suddenly flipped bullish because of the recent price action in Sears?
I would say, for if you invested in the $7, or if you put money to work in the $7 range, which it was just at only a week or so ago, you've done well. So you might be interested in taking those profits, because the company itself has said we don't know what our future looks like going into the fourth quarter this year. So being bullish on the stock, is very different from being bullish on the company. There's a really strong case to be made that come the Q3 or Q4 period, Sears Holdings may offer a broad, sweeping comments as to, many store closures, many divestitures, or certain aspects of the business that they're liquidating. I mean, they've been selling off major brands that within the store that are proprietary. So I would say you really have to separate the retailer from the stock, and if you've made a good profit, nobody's ever gone broke taking a profit.
That's right. Great advisement there. And finally, just to wrap it up, we're finishing up the first quarter, and we're coming upon earnings season once again very soon. What are your thoughts on the first quarter business cycle, and what are you anticipating for the second quarter or even the last half of the year?
I thought the first quarter was pretty strong. We saw a nice bump to GDP, I believe, this morning. But overall, I think business sentiment was strong. Job growth was strong. You had some, political shortcomings, but nothing that really impacted consumer sentiment for sure. We had one of the strongest consumer sentiment readings this week. So I think the first quarter was strong. Of course, from an investor standpoint, you take the good with the bad, and you have to follow the trends. If you're an ETF investor, you're probably going to do very well. But if you're forced to, be a stock picker, you have to really do your research, know the company that you're investing in, and really do your due diligence. Because for the retail sector, you're going to have your winners and losers. The brick and mortar retailers probably had another tough quarter. If we just look at the retail sales that came out, last month, it continues to show declines both year over year and month over month for department store retailers, and that's pretty much everybody that we talked about on this call, David. But again, you had non-store retailers growing double digits year over year, and that's your Amazons, that's your Wayfairs, that's all your e-commerce foes, if you will. If you're a brick and mortar retailer, those are your foes. So it's about knowing the retailer that you're invested in and knowing what stage of the business cycle they're in. Most of the retailers that we've named, I think, will have struggled during the first quarter. One of the big outliers during the first quarter for these retailers was the fact that income tax returns came in late, and you'll probably hear a good deal about that headwind for the quarter when these retailers report. So overall, I think it was a really good economic backdrop during the Q1 period. Going forward, I don't see that changing all that much. There's nothing in the macro environment that suggests Q2 will be different in any major way for the back half of the year. There's nothing on the horizon. If we look at it really optimistically, we may even get some acceleration in the back half of the year should some tax reform come to pass. So those are my thoughts on Q1 and later this year.
Absolutely. So I've been speaking with Mr. Seth Golden once again. Always informative, always some food for thought. If people would like to tap into Mr. Golden's expertise, one way is to ask him about the Golden Capital portfolio. And if people want to access that particular portfolio, how can they do so?
My direct email contact, seth.golden@coollinxit.com. That's COOLINXIT.com. I have all the information for the portfolio. Unfortunately, we're only allowed to add new investment capital, new clients in June period as well as January period. But we're always, ready to hand out, the information regarding the portfolio and how we invest capital throughout the year.
Yeah, and I've seen your returns, and they're very impressive.
Thank you.
Year over year, month over month, very, very good returns. I suggest people check that out. And of course, if people want to check you out on Twitter and StockTwits, how can they do that?
On Twitter, it's @SethCL, @SethCL, and on StockTwits, Seth Marcus. Also, one more thing, David, sorry to interrupt you. I've been updating my portfolio performance on a monthly basis. This far, year to date, I should say, we are pushing 48.6%. With one more day to go in the quarter, we're hoping to achieve the goal of 50%. So hopefully I'll have that update on Twitter tomorrow, and we'll see if I can hit that 50% mark.
I don't see why you wouldn't. And even if you, hey, you know what, 48%, 49%, I don't know about everybody else, but I would take that gladly. So,
Thank you.
Very good, sir. Thank you so much, Mr. Seth Golden. Please go check him out on StockTwits, Twitter. Email him with any questions, and if you want to get in on the Golden Capital portfolio, you're going to have to get in soon, because there are only certain times of the year when he will be accepting people for that, if you want to get in on those types of returns. Mr. Seth Golden, it has been a pleasure as always. Once again, thank you, sir.
Thank you, David. Have a great day.
Okay, you too.